Te Ao Fold e Mihine, ko Duncan Greive tōku ingoa. My guest today is Bryan Wilmot. He's the CMO, the Chief Marketing Officer of Stake. This episode is brought to you in partnership with Stake. And honestly, I'm super into it. It's what we're talking about here is investing culture. And I can understand how some people hearing that might go, oh, that's, how is that a fold subject? And it is because, and the conversation really kind of addresses that. Like, I've been as anyone who's listened to this podcast for a while will know, I'm like a bit long-term subscriber to The Economist and to Business Week, and I find the writing around business, investing, finance, and the way that you can see through that into culture, into politics, into policy, I've always found that really fascinating. And, growing up, I always loved Michael Lewis as an author who came out of Wall Street, has written brilliant books about culture and sports, but also about business. And yet it always felt out of reach. Like, what do you do with that knowledge, with that information? And what, companies like Stake have done is allow you to kind of, when you see and feel something in terms of the way that the sort of culture of the world is changing, the way behaviors are changing, as they have just so radically over the past 20 years. The biggest companies in the world right now, Microsoft, Apple, Google, Facebook, these are all in the 10 largest companies in the world, with the exception of Microsoft. None of them would have been, Amazon. They'd all been laughed out of the room 20 years ago, and yet now they've upended the world. And as a person of a certain age who was really paying attention, I could feel that coming a long way off. And I wasn't necessarily like in love with the world that they were making, but I knew it was coming, and I had nothing I could do with it. And that kind of gnawed at me for a while. And then with the arrival of these platforms, there's this way that you can kind of back your intuition and what you're seeing, feeling, your own behaviors about how the world is evolving and the companies that are remaking it for better or worse. And what Stake does, which I think is what distinguishes it and what Bryan and I spend the majority of this conversation talking about, is it creates content that wraps around this idea of the intersection of sort of culture, society, kind of structural and thematic shifts, and investing, and about this like idea that there's a whole bunch of people who are going to tell you that you shouldn't do this, that you should leave it to the professionals. They're typically the professionals, and there's an argument to be made there. But what we talk about is, on a long-term basis, they might be right, you might be right, and no one's suggesting that you put your whole, every dollar you earn into a Stake account and sort of figure it out. But this idea that you have an amount that's yours and where you can kind of play with and kind of just start to learn about how the market responds to the world as it's changing, I really think there's something in it. And I think it's not just a kind of COVID meme stocks, Wall Street bets, flash in the pan. I think it is almost like a new form of culture that's emerging in front of us. It won't be for everyone. There's a lot of people, who are, find the idea of investing, just getting too close to the fire of, of capitalism. But we're all investors. Like, we all have KiwiSaver. This is just a kind of a different way of doing it. And as certain of the kind of old sureties, we talk about this as well, like, buying a house just isn't the kind of logical given thing that it once was generationally. Like, it's, so to have a different thing that you hold, that you tend to, that's your own, that's this portfolio that you can have with a company like Stake, I don't know, personally, I feel like there's a lot in it. This is really the substance of the conversation. So we talk about using the Barbie movie as an example and the strategy that drove that from Mattel, thinking this idea that they're actually not a toy company, they're an IP company, and there's a bunch more examples like that. So yeah, it's a bit of an unconventional episode. It is brought to you in partnership with Stake. This was also one of the most fun and energizing conversations I've had on the Fold in a while. So hope you enjoy it. This is Bryan Wilmot, CMO of Stake on the Fold. Kia ora, Bryan. Welcome to the Fold.
Kia ora. Duncan, how are you?
Very good, very good. Great to have you over here to talk about Stake. I wondered if you could start out by talking about sort of where it sits in the market, like how you conceive of it and position it differently versus other online investing platforms.
Yeah, absolutely. So Stake we like to see it as where ambitious Kiwis invest. So what that sort of means, or in a practical sense, how we enable that is Stake is a share investing platform that offers the best access to the US. There's obviously a number of options out there from an investing platform perspective, but where we sort of position differently has been, I think from the start, the conception of our investor base or our customer base, the investors on the platform. We've always taken a bit of a stance of looking for or targeting the more actively engaged investor. I think if you look at the broad strokes of all the different types of investors out there, you've got people that are high frequency, super sophisticated traders that know the ins and outs, are very technical. And then you've got sort of beginners, punters that might just be in it for a quick buck. We sort of sit in the middle of that, where we want people that aren't necessarily the most sophisticated traders that need all the detail in the world, but have this actively engaged mindset where they actually want to learn about the markets and they want to grow their wealth over the long term and they want to be in it for the long term. So we're not looking for the quick fire, quick buck type investor. And we're positioned really around that mindset of this is a tool that I know that I can use to build my wealth over time. And as a result of that, probably the key difference in the way that we think about the Stake brand experience, whether that's the product itself, comms or content, is we actually try to take people deeper into the market and bring to life the dynamism and the interest that is there in all facets of the market and the investing experience, as opposed to sort of dislocate the markets from the user experience and make it feel like so unintimidating that you're not actually even being a participant. You just have your money sitting somewhere and you're not really sure what's going on.
Yeah, I mean, and I actually want to talk about the content side in a bit because I think that you guys do it in a really, you build that bridge really well in a way that I think starts your mind thinking about more critically about how there's actually investment opportunities or information around you at all times. And I think that's one thing that you do really well. I wondered, but before then, do you have a sense of what, like the profile of a typical Stake customer beyond that sort of market segment piece, but is there a sort of generationally defined profile that you have?
Yeah, as we've grown, we've obviously recruited a broader sweep of investors across the countries that we're in New Zealand in particular. But the sort of bullseye, I would say, is the next generation of investor, as we often refer to them as. So it's kind of like an under 40s, but it's a young professional, ambitious, working their way up their career and looking to really grow their wealth and take that sense of progress into their own hands and have that sense of control over managing their own progress and their own way forward. So it certainly is a younger profile. It's not like 18-year-olds, it's not 20-year-olds as the bullseye. We, of course, have some of them on the platform. It's really kind of the 35-year-old is the median age on the platform. And it's that young professional earning a decent wage and really just looking to accelerate their wealth generation.
Because it's such a new thing to be able to conceive of this. Like I remember 10 or 15 years ago, I was like messing around on like Investopedia and started to build a little mock portfolio because there was just no way to directly go into the US market. And yet it felt like all of the energy and innovation in terms of, the sort of companies that were reshaping the world were coming out of there, and they were sort of, you could feel them, but you couldn't kind of touch them in that respect. And I think that sort of direct to consumer or that level of access that's provided by companies like Stake is quite a profound shift for the traditional mindset of a New Zealand investor. It was previously a property investor, then it became KiwiSaver, which is the definition of passive. What in terms of that sort of next generation. Obviously you launched here in 2020. You had this huge boom through COVID. Is that sustaining? And how, what do you see as the kind of scale of the opportunity for that sort of customer mindset here?
For sure. So certainly see it maintaining. I think we've sort of come out of that peak COVID hysteria and the sort of inverted commas retail investing boom or the beginnings of it. And we've seen it maintain. People are in it for the long term. I think the media initially sort of typecast this generation of investors and retail investors as, reckless and not in it for the long term and don't know what they're doing. And as soon as the market turns, they're going to flee.
Patronising conception.
It's a bit of a look down the nose that like you guys don't know what you're doing.
Leave it to the pros.
Which kind of always seems to be the case when like a new generation comes and invades.
Any cultural space,
an established cultural space. So definitely we're seeing it maintain. And I think that's a result of it. It wasn't just COVID and it wasn't just, people had some cash and they were going to invest. I think that was maybe the straw that broke the camel's back in terms of actually opening the floodgate for people to come into the market. What we've seen through doing a lot of customer research and speaking to customers and people that are investing on the platform, whether with Stake or sort of broadly in the market, is that really it's sort of as a result of a shift in the sort of macro environment that this generation grew up in. So if you think back 30, 40 years, the sense of progress or how you would mark your progress going forward was very linear or very sort of clear cut. So you would get a university degree or, fewer people back then would get university degrees. As such, that would pretty much guarantee you a job in the space that you wanted to get a job in. You'd work in that job, work your way up sort of the corporate ladder. You'd maybe move companies a couple of times, but the sort of bouncing around between different career spaces and job types wasn't really commonplace. It was much more linear. You'd get married, you'd have kids, and to your point, you'd get into the property market and you'd start to generate your wealth off the back of that. So it was very clear cut in terms of the mold of how to grow wealth over time. You then look at this generation, university degrees are completely commoditized, for example. I think it was 1 in 10 30 years ago, people had university degrees. Now it's closer to 1 in 3. So it's much more commoditized. So that guarantee of I'm going to get the job in the space that I want is just not a thing anymore. It's sort of entry ticket. It's like if you don't have a degree, you're not even looked at. But it certainly doesn't guarantee you the employment. Then that corporate ladder climbing is definitely not as linear as it used to be. People are jumping between career types. So they're going from being someone in finance to being someone in design, and they're searching for sort of what really makes them tick.
Well, yeah, and not only that, right? Like, and this is where the investor piece comes in, is like the kind of sureties of the old kind of corporate era where, there were a big corporation would sort of own a particular piece of the sort of business real estate, and it could kind of sit there largely unencumbered for decades. A lot of the energy over the last 20 years has been firms that are directly trying to disrupt that, and that is actually, so you're kind of investing in the sort of much more chaotic, fluid landscape that is what you're witnessing out in the world as a young professional.
Yeah, exactly. And you're sort of seeing in terms of that chaotic landscape, it's basically the bottom line is that it's just far harder to progress financially or generally forward. It's far harder to have the world cut that out for you. And so what people are doing, the reaction to that is saying it needs to be up to me. I need to take back control and I need to take ownership of my own progress. And within financial, personal finances, that's very prevalent. And so this idea of, okay, I need to learn how to invest, I need to learn how to generate wealth is a reaction to just the way the world is working for this generation. And so COVID sort of hit. And as I say, that was kind of the straw that broke the camel's back in that, there was a spotlight on the markets. They were highly volatile and actually they've crashed and then continued to boom. People had extra money that they weren't spending because they weren't going out, and they had extra time because they were sitting at home. And so really that was maybe the catalyst that opened the floodgates, as I say, but the concept and the mentality behind why people want to invest and be actively engaged in the market is because they need to go and take control over wealth generation. And so for that reason, we're not seeing it as a flash in the pan. We're not seeing it as just a thing that happened for a couple of years during COVID. We're seeing it as this sort of systemic shift in the way that people are engaging with their personal finances.
Just on COVID, because I totally agree with everything you're saying, and yet that moment was extraordinary. And for a young company that was just sort of trying to figure out its way in the world to have that happen, what was it like to be inside it at that time, to sort of see? Because I've read a bunch about it, and the kind of Wall Street bets, meme stocks phenomena. They were huge global news stories, but you could actually watch it.
Yeah, I mean, it was fascinating couple of years, absolutely. So obviously we'd been in market and we'd been growing a customer base before COVID actually hit. So we were always around for investors looking for access to Wall Street. and wanting sort of that exposure to that market. And then, but yes, COVID was an accelerant to the business in terms of customer acquisition and obviously just general commercial growth. It was very fun. It was very exciting. Like you're seeing when things are good, it's like everything that you try you think is kind of working. And it's kind of one of those moments where you're just like doing different things and you're doing PR and you're doing all these things from a marketing perspective and you're developing new product and you're just growing and it's really exciting. The team's growing. You're building HR departments and legal departments and customer numbers are growing. So it's really exciting. But I think what we really tried to do was stay focused on who we were for before the boom happened. As in, what is that concept around the psyche of the customer or who that bullseye is from a mentality perspective. As I said, that person who is actively engaged, and whether they're brand new to market or they've been investing for 5 or 10 years, the unifying factor is that they actually want to be in there and do it for the long term and build their wealth. And so we really tried to stay focused on delivering for that customer from a communications perspective, or when we went above the line in advertising, all the way through to how we designed the product and the types of products that we brought to market. And I think that held us in good stead to actually have sustainable growth and attract the right customers through that boom, because certainly broadly the category, and of course Steak as being a participant in that category, recruited customers that were not in it for the right reasons. They were seeing, Tesla's gone crazy and my friend told me at a barbecue, so I just want to take a quick bet. I'm putting in $100 and I want to take out $500 is the aim within 6 months. So of course you get those sort of customers, but if you start to believe that is going to be the sustainable aspect of the customer acquisition, that's when I think you could fall over. So of course we have no problem servicing whichever investor wants to come to the platform, and we don't really pass judgment on how you should invest, but we still do have a viewpoint on who the core Steak customer is. And I think it's that aspect through that COVID period that has sort of solidified, where we are now as a business, continuing to grow going forward.
And one way that you sort of essentially articulate that is through content. And I think that the way that investing was articulated when I was sort of growing up in 90s, 2000s was, it almost was like willfully boring. Like the big companies just, they kind of
trying to keep you out.
Yeah.
Trying to keep a bit of confusion in the space.
And because a lot of it didn't make, there was the sort of the world of investing and then there was the world of consumption, and that you didn't see that those things were linked. And I think that, in recent weeks you've written about sunglasses and the way that basically every pair of sunglasses actually ultimately ladders up to the same company, and even very pop consumer brands like Levi's and Hershey's and not just the fact that they exist, but the sort of prospects of them and how these kind of actually decades old iconic companies are navigating this much more sort of fluid landscape. How did you sort of hit upon that idea to use content, to use media as a sort of a fundamental bedrock of how you interacted with your customers?
For sure. So I think structurally, or as a mechanic, why content? I think the first reason is that when you're a startup and as we were growing, budgets aren't huge, and you can't just go and necessarily spend heaps of money to just acquire customers. And so what that forces you to do is really focus on your existing customer base and go, look, if we can engage them really well, if we can create something that they absolutely love from a product and just a general brand experience perspective, they will go and advocate. And we saw in the early days, because we really tried to focus on that core customer, that word of mouth was a huge growth driver for us. And part of that strategy was, okay, well, how do we deliver content in a way that is different? As you spoke about, typically it's eye-wateringly dry. It's heavily analytical, which is great from the contents of that content, but it's not the way that this next generation want to consume media in any regard. So as a mechanic, content was always a very important part of driving community engagement, and it's sort of maintained its role within that going forward. In terms of the actual the direction or the creative aspect of that idea of how do you embed some cultural nuances or cultural stories into the idea of your market or finance content. If I can go a bit deep for a second, there's sort of where it comes from is that investing has become a sort of a subculture in and of itself. So as you sort of spoke about earlier, it's it used to be this thing that was just a transactional finance discipline that you sort of learn, and people that did it in a very transactional way. What we've seen now as a result of this idea of, it signals to the world that I am someone who is taking care of my own shit and I'm someone that's actually trying to progress myself forward, which is an aspirational sort of pursuit these days. The like rise of the entrepreneur and people that are going out and making their own way is kind of culturally put on a pedestal. So having something that can sort of symbolize that or badge you as one of those types of people is something that then people like to go and display publicly. So investing has taken on this sort of subculture. If you think about the way that people engage with music or fashion or whatever it is, there are WhatsApp groups, there's forums, there's memes, there's in-jokes, there's all these sort of things that beyond the core thing of it, which is in this case the investing, the transactions of buying and selling shares, there's a whole world that you can go and explore and play with and socialize and all that sort of stuff. And we see that emerging and sort of burgeoning within the investing space. Like there are these Facebook groups, there's WhatsApp groups, people share content with each other, people share ideas. We even had a customer or group of customers in New Zealand who set up a company and were investing sort of as a syndicate through a company. And each month they were allowing one of the people in it to make the investment decisions. And obviously there was discussion through a WhatsApp group. And then at the end of the year, they would have the company, I won't say the company name that they had set up, but the lunch, like an end of year Christmas lunch for that group of people. And you kind of think of that, that's like very fantasy football-esque, where you've sort of got this group and you're discussing ideas and sort of having a bit of banter. And then at the end of the year, you've got that lunch moment. We all come together as a group and celebrate. So we're sort of seeing that subculture forming, and it's really kind of formed now, but it's continuing to form around investing. And so what that then creates is just the engagement style. So we knew that content and the brand experience needed to be cultural and sort of match the way that the consumer was engaging with the category as a whole. And then secondly, what it also has resulted in is that people are now seeing the world through the lens of the markets. As they become more educated and they become more entrenched within thinking about investing, they're looking at a new iPhone coming out and they're going, oh, I wonder what the impact on Apple is going to be. The Barbie movie is a great example. When there was such hype around the Barbie movie, we saw on the Stake platform Mattel become one of our most top traded stocks, and it had basically never been really traded before that much. So you can sort of see this behavior of people are looking at what's going on in the world and they're sort of trying to work out and translate, well, how will that impact from a financial perspective or a stock price perspective? And then they're going and doing research around that. And if it's something that they believe in, they'll go and buy. So we sort of noticed this behavior emerging of going, well, it's this intersection between culture and the markets that is becoming, as you said, it's not so disparate anymore. They're actually, they never were disparate. It's just that people didn't really take that perspective. But you're seeing that happen now. And so we found that sweet spot of going, okay, well, if we can have conversations about the markets, but through the lens of, a cultural insight or a cultural happening or something that's just generally interesting or loved by people, they're going to be A, very engaged by that, but B, it's also sort of matching the way that they are thinking about the markets and going and making their investment decisions.
It's so interesting because it is like, it's a guy who grew up reading music magazines, like, and that was my identity. It was how I sort of started to understand the world. And I think that it's weird, right? Like we're living in this sort of post-monoculture era where there are, there's all these facilities to build community and all these sort of niches. But because we live in this sort of very globalized world at the same time, the fact that investing as a form of culture unto itself, that basically once you start to see the world and see the kind of rising and falling of different elements within it as something that's ultimately kind of information that can be processed into a sort of an investment decision, it's kind of hard to unsee it once you get into that mindset.
Absolutely. It's kind of like looking behind the curtain, and as you get more experience, it's not about becoming a finance expert necessarily. Like people are certainly looking to upskill on, investing strategies and read about company deep dives and all these sorts of things. But there's also just a broad lens that like once you sort of start to go, that everything affects a share price. Like the market prices things in pretty instantaneously. And based on all these little spikes or announcements or whatever that actually previously I just consumed as a consumer of the iPhone or as a consumer of movies and Barbie, I can now see that next layer down and I've sort of peeked behind the curtain. You kind of can't unsee it, as you say.
I mean, it's interesting, right? Because, for example, with the iPhone's a classic example. Like this is a large purchase that you're making, and you can look at, iPhones tend to run in clusters. Most of your friends probably have them. You look at the replacement cycle of them. You think about what the impact of the USB-C versus the Lightning change. How will that kind of flow out into people's behaviors? And then you can start to go, well, how will that impact the sort of device replacement cycle? So you can almost like hedge alongside this actually quite hefty consumer purchase of your own. But even into like I thought the Barbenheimer phenomenon, particularly the fact that actually if you look through it into that new strategy of Mattel, where he's basically like, we're not a toy company, we're an IP company.
Yeah, exactly.
And there was a lot of people were making fun of that dude a few years ago, and he'd been saying it for a little while and didn't actually have a lot of things he could point at. And so, I do think that there is really something in the fact that you can look through it into a kind of, it's on some level it's corporate strategy, but on another it's kind of it's big established companies learning how to see the world the same way that the young insurgents did and kind of make changes as a result.
Yeah, exactly. I mean, Barbie's a great example. I mean, it's got this asset in a very popular toy concept or, doll, and then it's got this huge brand attached to that. And as you say, they've completely repositioned from it's just the doll and it's just the toy to it's basically what the movie was the revival of the franchise. I was saying to someone a couple of months ago when it was all happening, I was like, thinking forward to Halloween, I guarantee you there will be heaps of Barbies and heaps of Kens and whatever the other characters in the movie was. I haven't quite seen it yet. But when was the last time that potentially the most common outfit for Halloween was Barbie? Probably not since like 1990.
It almost felt unrevivable in some respects. It felt so kind of antiquated, and yet now it feels like incredibly urgent and current.
For sure, and I think they've obviously shifted the inclusivity aspect to it and modernized the way that it manifests and the concept of what a Barbie is. I think they've done a pretty good satire job
and so on.
Of bringing that into 2023. But conceptually they've turned it from a toy into a franchise, and you could see how theme parks could have Barbie rides, and you can see how there can be consumer kits for whatever it is and dress ups for Halloween and all this sort of stuff. And really, I think the movie obviously has been the sort of the start point for that, but I would not be surprised to see them diversifying into a number of different ways where you go, the Barbie brand and the engagement with that is kind of the entity and it's the franchise that consumers will buy into across a number of different product lines.
So thinking about, other sort of moments over the past few years, are there any other kind of things that stand out where you sort of started to see trading action on the platform, like a sort of a sleepy stock just become incredibly widely held, or and could link that up with phenomena? Anything that stands out in particular?
Yeah, it happens all the time. So I think toward the end of last year, Manchester United was coming up for sale, or the ownership was going to change, and it's listed on the US market and obviously available to be traded on stake therefore. And we started to see, just as the different news cycles or the different announcements around that deal were coming out, that trading behavior was starting to match. And it's also interesting to look at the buy-sell ratio, so you can sort of see how people are perceiving the stock, whether they're sort of holding it or whether they're getting rid of it. But certainly just absolute trade volumes. Even when WrestleMania, I think, was on in January and I think came to New Zealand, we saw New Zealand investors sort of getting behind the WWF or WWE brand and stock. So all these sorts of things, absolutely.
That's so interesting. Yeah, and again, like, people can be fans of sports, and it's a mindset shift to realize, actually, I've got this huge emotional investment in this team, but I can actually make a tangible investment and sit on this thing for years. If I really believe in UFC or some other kind of form of publicly traded stock, I can actually make that real.
And that's what's exciting about, I think, the Wall Street market and the US market is that mostly these big global brands are listed there, and these companies that really are driving categories at the sort of leading level are available to be traded on the US market. I mean, Nike is another interesting example. It's a bit of an older one now, but when that Last Dance documentary came out and it was on Netflix, and it was all about Chicago Bulls through the 90s and Michael Jordan, and obviously Nike being such an intrinsic part of that story, we saw, Nike is a reasonably popularly traded stock, but we still saw volumes jump 35%. And it's interesting to watch the difference between these sort of flash in the pan moments and what investors actually believe are going to be seismic shifts or really positive, sustained shifts to a business model. I mean, Barbie is a great example where we saw, the share price actually move and share volume go because people are seeing that as, well, there's growth potential in that strategic shift versus, something might generate some attention, but then with further research, it's actually not that attractive of an opportunity. So you sort of see those divergent behaviours happening as well. So
thinking about New Zealand specifically, this country had quite a different experience of the pandemic to maybe a bit more similar to Australia, but certainly other markets that you operate in have had a different ride, whether that's the sort of inflation elements or the sort of length and pace of the lockdowns and so on. Have you seen, are there sort of distinct elements to the way New Zealanders are using the platform that are sort of specific to us, or is there really a globalized investing community and culture?
There's definitely nuances. I think what we're seeing in New Zealand in particular is that sort of through the COVID period, there was much more of a behavior around stock picking. Like, I'm going to pick Tesla and try to ride it up, or there's a new EV out of China like a Neo or whatever it might be, and that's a great opportunity. I see growth, and everything was kind of a winner back in those days. I think what we've now seen is obviously interest rates have gone up, inflation's going crazy, wage growth isn't really keeping up with inflation. And I was actually looking at a Spinoff article from 2021, which was comparing housing prices from 91 to 2021, sort of that 30-year period, and looking at, well, in 2021 dollars, what would your salary have to be to afford a house with 40% of your salary going toward repayments or something to that effect? And essentially it's 3 to 4 times the amount in 2021 as in terms of versus 1991, how much you had to be earning just to make repayments. So there's the interest rates, which are a lot higher than they were during COVID, but I don't think they're broadly that high in terms of if you look back on a 50-year average. So it's not actually the interest rates themselves that's really making it difficult for people to get into the housing market. It's just the absolute price of things. And so that sort of wealth generation is seemingly very difficult and is kind of seen as unaffordable. And then even just cost of living, like just groceries, I've heard stories of people actually shipping groceries from Australia and paying the cost of freight, and it's actually cheaper than going to the grocery store here. So I think New Zealand in particular is very hit hard by, cost of living in certain elements. And certainly housing is a really strong or really expensive underlying factor. So you sort of got all that, and what that's resulting in is that people have started to see their primary wage as not really even sustainable to keep up, let alone get ahead. And as I was speaking about earlier, there's this drive and this motivation to progress. And so what we're sort of seeing is that people now really are looking at the stock market not as just these sort of short-term, let's pick a stock. They're looking at, how do I really set up a portfolio that is about long-term wealth generation? And so we're sort of seeing a bit of a shift, or a lot of a shift into, the primary portions of the portfolio. There is still that stock picking behavior. Like, people still want to have, a bit of a crack if they believe in a certain stock or they see some, outsized growth potential. They still want to have a go at that. But the lion's share of the portfolio for our New Zealand customers is moving into, ETFs based around thematics. So it might be, pharmaceuticals, or it might be technology, or it might be AI and robotics, whatever it might be. They're going, okay, I have a long-term horizon here, so I'm going to get behind an ETF that sort of just tracks that over time. Or it might be index ETFs. So it might be, I just want to follow the S&P and the performance of that. So I believe the stock market will grow over my longer-term horizons now, and I'm shifting into more of those passive assets that will they may not return me, 200% in the next 6 months, but they will return me good gains over my 5, 10, 15-year horizon. So it seems that people are now looking at the stock market as a real wealth generation tool to sort of supplement the fact that primary wage is just not enough to keep up, let alone get ahead.
Yeah, and I think that's the thing that feels quite sort of fundamentally different about the way that generation is engaging with stock markets versus I've been reading recently about the 87 stock market crash and the sort of mania that preceded it, which in New Zealand was on a global scale. It was frothier, and then the crash was harder and more sustained, and that had a real impact in terms of making people leery of markets over the long term. Like, I think our NZX 50 hasn't recovered the losses from 1987, which is just kind of a stunning,
astounding,
fact. But and I think as a result, there was a sort of a sense that greed was the underlying motivator that fueled that. Might even have been true back then. But if you think about the dynamics of a person in their 30s now, that track that you described right at the start, the get your degree, get married, buy a house kind of thing, it's just not nearly so obviously there. So, and yes, you have your KiwiSaver, but if you want to sort of generate wealth, and if you sort of see that these structural shifts in kind of behavior and markets and so on are really fundamental and there forever, I think it's a there's a real kind of rationale to saying I want to build a portfolio that is my own thing, that's sort of separate from that I can sort of tend to like a garden over long term and not, I'll look at it all the time, but I'm not actually going to touch it in any profound way potentially for decades. And there's actually that's quite a profound shift in behavior that I think a platform like yours manifests.
Definitely. And I think, people, that's why, we sort of offer the product that we do with, the Wall Street offering, because people are looking for diversification. So obviously the NZX is an attractive market and many investors do invest here. New Zealand or Kiwi investors invest on the ASX as well, but it's about diversification and there's a lot of different opportunities that aren't accessible on the NZX or ASX on Wall Street. But yeah, certainly I think people are sort of pruning these portfolios over time. And the sense of control is a real primary driver. The idea that, I can't necessarily trust the world to roll out the red carpet for me or all the building blocks to just get me anywhere that I want to go. It needs to be done by myself. And, the markets present the opportunity, for supreme control, because you get to buy and sell what you want and curate your portfolio as you perceive things. So if you perceive AI to be a fad, you don't go for it. If you perceive it to be a game-changing technology that is just going to redefine how we live and how society operates, then you do invest in it. So it's supreme control, and then it's also a lot more accessible. I mean, on average, our investors' portfolio size is about $10,000 USD, but you can, if you wanted to, invest from as little as $10. But I guess the point being that you don't need these enormous deposits, you don't need these enormous capital outlays to just get started and to start building that wealth. And I think that sense of action that you can take with a more accessible level of funds or capital that you can sort of deploy into the markets versus into something like property, you can just get cracking right away. And I think that's attractive as well. Yeah,
I think in this era of a sort of lot of distrust and a sense of that institutions that you previously had relied on, they aren't necessarily offering you the same deal they might have offered your parents. That sense of agency that you can go and being this thing on your own terms and everything else. Well, I hope it's true, but I don't necessarily believe it.
Yeah.
I can really see that. Hey, Bryan, this has been so interesting, and I've kind of wanted to get into the sort of investing culture place for a while, and this has been such a fun way to do it. Thanks.
Great. Thank you so much for having me. It's been great.
That was The Fold, brought to you by our partners at oOh!media, making brands unmissable and public spaces better across Aotearoa. Huge thanks to oOh!media for sponsoring this episode of The Fold and enabling us to make unmissable connections with Kiwis.